price does not move randomly in Forex. It feels that way at first, but there are real forces behind every spike, every reversal, every quiet stretch on the chart. Professional traders watch the same handful of drivers, day in and day out. Here are the 5 that matter most. The first, and probably the most powerful over the long run, is interest rates. Money flows toward higher returns. When a central bank is expected to raise rates, that currency tends to attract more demand and strengthen. When rate cuts are expected, the opposite tends to happen. You do not need to predict every central bank move. You just need to know when those decisions are coming. The second driver is economic data. Reports like inflation figures, employment numbers, GDP, and business activity surveys, these move Forex markets fast. And here is the key insight. Markets do not just react to whether a number is good or bad. They react to whether it beats or misses expectations. A strong jobs report that was already priced in can do almost nothing. A slight miss on inflation can move a pair 50 pips in seconds. Beginners should be especially cautious trading right before major data releases. The volatility can be sharp and unpredictable. Third is central bank communication. Rate decisions matter, but so does everything around them. Press conferences, meeting statements, speeches from senior officials. A single phrase can reprice a currency pair in minutes. This is especially true for the euro, the dollar, sterling, and the yen. The market is always trying to read what central banks will do next, not just what they did last week. Fourth is risk sentiment, the broader mood of global markets. When traders feel confident, they tend to move into growth-oriented assets and currencies. That is called risk-on. When fear takes over, capital moves toward what are considered safer havens, the dollar in many situations, the Japanese yen, the Swiss franc. If markets are in panic mode, your usual technical setups may not behave the way you expect. That is a good time to reduce your exposure and trade smaller. Fifth is liquidity and session timing. Forex runs 24 hours a day, but it does not move the same way all day. The London session and the New York session tend to produce the cleanest, most consistent moves. The overlap between those two sessions is often the most active window of the day. Choppy, low-volume conditions can produce erratic price action that is harder to trade well. These 5 drivers rarely act alone. A data surprise shifts rate expectations, a central bank confirms the new direction, sentiment flips, and the biggest move hits during peak session hours. That is why Forex can erupt from a chart that looked completely quiet. If you are still building your understanding, practice first with a demo account before putting real capital at risk. Trading involves real losses, and you should never trade more than you can afford to lose.